And right now, I see a huge opportunity. Welcome back to the show. I'm Ozbourne Foreman, and this week I'm going to be talking about the UK entering a recession. I'm also going to be talking about comments I get asking why I'm invested in UK stocks if they've consistently underperformed other developed nations. Therefore, they are absolute shit. I should give up, change my strategy, and drop one of these for the YouTube algorithm. Firstly, I'm going to talk about the portfolio's performance this week. The FTSE 100 has gained 0.99%, the FTSE 250 has gained 0.65%, and my portfolio has gained 4.6%, bringing my portfolio value to 11,228.98 pence of close of Friday, the 14th of August. And I think this now marks the 5th or 6th consecutive week that I've outperformed the market. But as I've said in the past, I've got to be very careful here not to be hubristic and get overconfident in myself, as eventually, if I do continue outperforming the market, subconsciously I might start believing that, well, I'm so good at stock picking, why should I even bother? Oh no, this wasn't my fault, the company's terrible, therefore I'm still amazing. Like, you can really blind yourself with bias, and therefore you're very likely to then start underperforming the market, but because you'd have such a negative attitude towards it, you would very much dismiss it and blame it on someone else. Fortunately, YouTube and Twitter keep me grounded in my decision making, as you guys in the community would surely reach out to me if I do something outlandish. And speaking of Twitter, I'm really close to 100 followers, and it'd be really appreciated if you'd follow me at Ozbourne Foreman, or the link in the description below. And don't worry, I'm not going to spam you with YouTube content, but try and provide extra value about how I'm growing on social media, or also about the portfolio behind the scenes. So please consider following me at Ozbourne Foreman. Ashtead Group, or more likely known as Sunbelt Rentals, formerly named A-Plant in the UK, have recently acquired an industrial warehouse of around 26,000 square feet of buildings and around 5 acres of land. This was acquired for £2 million in West Yorkshire on the M4 corridor, which is an excellent place for businesses, and many have done this and set up shop. However, the important point behind this is not that, wow, look at this stock, they're expanding out in such a time of uncertainty. It's the fact that it's showing how resilient the industrial sector actually is. And it's the fact that they're able to do this, not because they're so well managed, but because there is still a demand for agriculture tools, equipment, and also such as construction tools and equipment. So this definitely means, whilst yes, we are in a terrible position economically, that the industrial sector is still going strongly, and they still need all of these equipment, and therefore it just shows it's a little bit more resilient than the rest. And obviously with Brexit on the horizon, it's pretty impressive that AHT can continue buying assets, or in this case, I believe a leasehold in which they are leasing this site until 2031. But regardless, the fact that they are buying up these different properties means that business is going fairly well, and subsequently they can rent out or lease out more products, which suggests to me that our construction and agriculture industries are actually doing a lot better than the doom and gloom we heard earlier in the year regarding the pandemics and the fears of a no-deal Brexit. Regardless, Ashtead Group is well diversified, and no doubt I think they will survive the outcome of the pandemic and also the outcome of Brexit. And the only real impact I feel that Brexit will have on Ashtead Group is the currency conversion between their diversified earnings. So they may have a lot of money in dollars, and as that weakens, they've got less spending power in the UK. AHT is up 2.2%, which was part of the rebound on around the end of July. I own 33 shares and currently I'm up 4.88%, although the position is still underweight by around 2.1%. This week actually ended the incredible rally of Softcat, which is Software Catalog, or my defensive technology stock that I have in the portfolio that provides IT value infrastructure and also sells on IT. And this is likely a combination of Berenberg, who are analysts and forecast the growth of a company, and they effectively said that whilst yes, they'd increased their price target from 1,100 pence to 1,250 pence, and that they believe that Softcat will, and they've upped their estimates for Softcat's growth by 10% or double digits, that they still feel that their competitors are better placed than Softcat themselves. And this is because while Softcat are a brilliant company, they are lacking in some areas, and therefore customers who are looking for IT infrastructure might go to one of their competitors who are actually more optimized and can give you all areas at a good deal. well, rather than Softcat perhaps lacking in certain departments, and therefore it would be a lot less hassle to go with the competitors. However, I do believe Softcat are aware of this and they will look to change this. I still think there's excellent growth opportunities here, and I believe they only have a 7% market share in the UK. But with time, they can work on this and really pull through. However, that did mean that the rally had popped a little bit. And I think this is also due to the idea that, again, there's uncertainty in the market around the pandemic. So you hear it every week, really. And all of these tech stocks were rallying, Softcat included, and it's kind of just bursted and there's a bit of reality there. It makes sense, a little correction. I'm likely going to be averaging into this because I don't really have a big enough position with Softcat, and right now, whilst yes, it is higher than my average price, I might as well get some more equity in there for the future. And this is because Berenberg had mainly said that they'd changed it from a buy to a hold, and it is as basic as it sounds. It effectively means that they're saying, you shouldn't keep buying this, but rather just hold on to it and you'll likely do okay. I agree with the verdict and actually feel that this stock was more than due a correction, merely because the fundamentals hadn't really changed. Obviously, they had that partnership in which they were reselling IT work from home technology, which I'd mentioned about a few portfolio updates ago, but this wasn't really a game changer for them. It was just something they added. This week, Softcat are down 6.5%. And since I only have 3 shares, it doesn't really impact me at all. As I said, I'm going to average into it. And I'm going to make the most out of this opportunity as they're an excellent dividend payer and likely the highest yielding stock in my portfolio once they resume it. And with the upcoming results, I do believe they will be quite good, even if competition may become more fierce. This week, Boohoo had an RNS announcement, which is a regulatory news service. And this is basically released when there is information that the company needs to release, which may impact the overall share price of the company. So effectively, anything fairly important that could impact it up or down needs to be released. And they believe there's a regulation where they have to get it done as soon as possible. In this case, the action took place on the 12th of August, but it was released on the 14th of August, Friday, at around 2 o'clock. Well, a Jupiter Fund Management, who had owned around a 10% stake in Boohoo, had actually reduced the size of the stake. However, this is because I believe the threshold for owning a stake in a company like this is 10%, and therefore you can't own much more than that due to certain regulatory measures put in place. And so I suspect that it wasn't them just selling, but because they'd loaded up on shares in the drop, that what happened is that they have to sell, or they'd have to conform to new laws in place, or maybe higher taxes. I personally don't know. But what it means is they've ever so slightly reduced it so that they went from around 10.13% to now 9.93%. Effectively reducing some of their share pool so that they can stay within it, but they're also taking profits, as obviously they probably made money from this too. And whilst you think, wow, this is a terrible thing, right? That an institution has just cut their position, they're trying to minimize losses, effectively just meaning that they've made money from it, that their stake in the company was actually increasing, so now they just need to cut it down a bit. And this would explain some of the stagnation in the share price. I know that investor sentiment had changed at the end of Wednesday and started to dip in the general market, and so it does make sense why Boohoo would also stagnate, although recently Boohoo was less connected to the market, and so I wouldn't have expected it to have dropped that much, and it didn't really. Since I've created the channel in April, I've had various different comments asking me why I'm not invested in the US, as UK stocks aren't good and they don't go up. And I just want to disclaim that before going into this, I'm not arguing with these people, but rather reading their points, seeing what they have to say, and then putting my point against it, which I guess is an argument, but I'm not personally attacking the commenter or judging them for what they've said, rather just giving my point for what I do. And in fact, I've made 2 videos on this topic in the past, which would have been about why I don't invest in US equities and why Warren Buffett doesn't buy UK stocks. However, I do feel that I need an updated version of higher quality. Firstly, the idea of UK stocks not going up. And I can completely understand why someone may say this, as you could look at the FTSE 100, which is the 100 highest companies or highest market cap companies listed on the London Stock Exchange, which are very globally diverse and mature companies. And in the last 20-25 years, they would have only given you a return of 80%, as it's remained very stagnant or very cyclical. And so it would go up, but then it dropped down, and then it never really recover. And it's done that for the last 3 market crashes, such as the dot-com bubble, financial crisis, and recently the pandemic crash. Then if you look at the S&P 500, which is the United States' biggest 500 companies, you'll then notice that in this same time frame, they've gained around 500%. However, what separates the S&P 500 with the FTSE 100 is actually the dividends. The FTSE 100 was never a high growth based index. It was mainly full of mature companies that are globally diverse and that are making so much cash that they aren't going to be able to grow it quicker, but what they can do with that cash, because it's all spare and they don't really need it, is that they can give it out to their shareholders in the form of dividends. And so they give them dividends rather than trying to grow the share price, as it is more difficult to do so. However, they would likely be doing share buybacks as well, but obviously dividends reward the investor. And that's why in the UK, we have much higher yielding stocks, or we did at least before the pandemic, and we're actually in a better position to receive dividends as the UK has things like dividend allowances and lower tax rates on dividends, whereas the US would be taxed more, I believe, and so it's more rewarding for them to buy into growth stocks and not be taxed as much. But then also the FTSE 100 has these big dinosaur companies like oil and gas. You've got Royal Dutch Shell, you've got BP, you've got financials, you've got like HSBC, you've got all of these big and dying businesses. Well, you've got these big businesses that are dinosaurs. They're not really doing much. In fact, they've got healthcare businesses as well, which are probably the two that are doing the most. Although GSK and Shell, they hadn't grown their dividend in 5 years. Same with AstraZeneca, right? Like, they're so big that they don't even care really about growing the dividend because it was a high enough yield already. And what makes me laugh even more is that GSK has struggled to make money even in a pandemic. Regardless, these stocks aren't great, and therefore you wouldn't expect the returns of the FTSE 100 to be that good either. I mean, GSK has been trading sideways for about 10 to 15 years. Shell has been trading sideways. I think if you'd have bought it 20 years ago, you'd still be down today. And same applies for BP. HSBC and the banks, which do take up a high market capitalization of the FTSE 100, are obviously not in the best situation. They are struggling with low interest rates currently. And obviously after the great financial crisis, they are still having to recover from it. That means in the UK, people are definitely more focused on dividends simply because all of our companies pay higher yields, and therefore it's more rewarding for us to buy into dividend paying companies. As I said, with the dividend allowance, we also have ISAs in which dividends can build up freely, compound our growth, and therefore we would be able to draw from it in the future in retirement, or even as early as you can, we could draw tax-free dividend income from it as much as we want, so long as the money we've deposited into the ISA is there. So, if you had invested £10,000 in 1986, the start of it, in the FTSE 100, and without dividends reinvested, you would have around £53,000, which really isn't too great when you account for inflation, and it's more or less not much. And considering how long you would have held that money, it's not really a great return on your investment. However, if you'd have invested £10,000 in the FTSE 100 again, but then reinvested every single dividend you received straight back into it, you would have a significantly higher figure of £195,000 over the same time period. And this is effectively a compound annual growth rate of 7.75% with dividends reinvested, or around 5.77% without dividends reinvested, which is still a significant gain each year, beating inflation, and really does mean that UK stocks do go up, and it certainly would set you up for the future, especially because we have tax advantages with UK stocks, whereas we might have withholding tax with US stocks. But when compared to the S&P 500, who since from the same time period of 1986 to 2020, they've gained an annual return of 10.87% with dividends reinvested, or without it, 8.34%. Yes, this proves that historically, the US market is in a better position and has outperformed pretty much every other nation. But this doesn't mean that history is going to repeat itself and that US is always going to be outperforming every other nation. And 60% of you watching this video aren't subscribed, so please consider subscribing, as it doesn't cost a penny and is overall free. Thank you. Now the UK economy is struggling more than any other developed nation except Spain, and we are possibly in the deepest recession of any of our lifetimes. However, have you noticed that it still feels like we haven't actually left a recession. Obviously, when I was younger, I was still a kid during the global financial crisis of subprime mortgages. And so my biggest worry at the time was when I could next play football with my school friends. But it doesn't really feel like we've ever really left it or returned to where we were. I mean, in terms of GDP, we very likely have, but wages haven't really increased that much. And it just seems like we've been trailing behind a bit. It really doesn't feel like the lifestyles have really changed that much, other than the fact that technology is more prominent in our lives. And obviously, I'm going to be significantly blurred on my opinions of 2008 and 2009 as I was just a kid. But at the same time, it doesn't really feel like this counts as a recession. And technically, to count as a recession, you need to have 2 quarters of negative GDP growth, which basically means that our overall productions and what we produce and sell would have been less for 2 quarters. So for 6 months in a row, we would have had negative, we would have had less than the quarter the year before. But I feel this is because we'd shut down so many businesses and locked down the whole of the country for such a large extended period that we effectively forced this to happen. I mean, what did we expect? Obviously, yes, for the safety of our population and the pandemic and getting that herd immunity, which is 95% of the population, and subsequently not overwhelming the NHS, it does make complete sense why we did it. But it's the idea that we are in a recession, but only technically. However, since we've done this, there are obviously more issues that are coming ahead. And because we were in lockdown, many businesses weren't making money, and therefore they've had to make redundancies despite the furlough scheme, and that ends in October, which also probably means that more redundancies will be made. And therefore, we are entering a recession again, simply because there's going to be so many job losses in the economy, or so many people unemployed, that effectively we're back at square one. And subsequently, since obviously we were all on furlough, many people are actually saving more money since they're not out in the high street, or a lot of clubs and pubs were closed for a long period of time, and therefore they've saved it up. And now they're playing it more cautious, which means money isn't passed around as much. And it's not like people are putting money into the businesses and then the businesses can buy more things, and therefore we have our money and we can obviously keep the economy going. But because people are hoarding it and holding it together just in case, this obviously means that we are now going to be shrinking as an economy. And over this time period, our economy has shrank by minus 22%. So effectively, we'd lost a fifth of our economy. But then this is combined with the idea that the UK economy is largely focused on services, hospitality, and consumer spending, in which, compared to our European countries across the seas, they don't have anywhere near as a large proportion of what we have here. A lot of them are very invested in manufacturing, for instance. And so what I see happening here is that obviously we're going to be the hardest hit. So we're going to be the hardest hit on paper, other than Spain. But also, this might present an opportunity for our businesses to rebalance. I know that sounds a bit dark, but really, it does feel like some of other businesses will become more prominent during this time period. We might see a rise of tech companies in this time, and therefore it would make sense, and then we would have more exposure to tech, as I think in the FTSE 100 we have something like less than 3% exposure to tech, whereas the S&P 500 is like 27%. But perhaps we might see some more niche businesses, such as specialist, high-skilled manufacturing. But then there's also Brexit, in which this is coming up, and we're going to leave the EU with or without a deal by the end of the year. And we have not postponed the idea to negotiate this deal with the EU, which could devastate our economy much further, and we could really struggle for years and years and fall behind many of the other developed nations. I believe it's really the uncertainty that worries our citizens, population, and investors. And that's why the markets haven't been performing too well since around 2015, as it is all priced in. And right now, I see a huge opportunity for investing in the UK. This could honestly be the perfect storm for us. The idea that there's a pandemic that's ravaged our economy, A lot of us are in lockdown. We're in possibly the deepest recession ever. But there's also Brexit looming. People are worried. We might not get a deal. It really puts it into perspective, and it should be pricing these stocks a lot lower. And subsequently, since our economy is in a worse state, there is a lot more potential upside. And in 10 years from now, people could be thinking, oh, I really should have invested more in UK stocks. They've had the best decade in history. Oh, but I wish I hadn't have invested in US stocks, because whilst yes, they did okay, they didn't do as good as UK stocks. And since the pound gained on the dollar, I effectively made less returns because of currency conversion. And look, I'm not bashing on US investing. I completely understand it. They obviously have the larger economy and there's a lot more investor sentiment over there, hence the higher PE ratio for the market. But I do feel at the moment, sure, the dollar's weak, it's trading at around £1 to $1.31, but have you not seen 5 years ago where the pound was trading at around 1.6, 1 to 1.6? Or even before that, yes, as a long downtrend, we had seen the pound slowly and steadily decrease against the dollar. But I do think this will change. And after Brexit, we'll then see that, hang on, this really isn't that bad. And we have the cards currently, right? The EU, I would argue, are in a much worse position than we are right now. Yes, our economy has shrunk by more, but they have 27 different nations in which they have to monitor and keep an eye on. And obviously, a lot of those nations right now are likely struggling. And so we've kind of in the position of power to negotiate and get the EU to accept our terms of the deal. Not to mention that other countries are also going to be struggling, and so they are going to be more open to the idea of trade, such as Australia, the United States. I would say China, although obviously there are some tensions there, but I don't see why not, unless obviously we're invested too much in Hong Kong and they say no. However, this obviously could be turned in reverse, as the EU is our biggest trading partner, and I believe it makes up for something like 50% of our earnings. So yes, it does make sense that this could happen and could present a potential risk. Although I strongly believe that actually, even if we come out of this quite bad, since our economy has retracted, there's a lot more growth we can do. And since our economy may be smaller than other developed nations, we can really build this back from the ground up. And since we have our own currency, our own government, and our own land, this really could be a pivotal moment in rebuilding the UK. And we certainly have specific sectors that we really benefit from. We have high-skilled biotechnology right now, and we also have high levels of tech. We definitely could strive further, and especially if we have some of our tech companies like the challenger banks like Monzo, Starling, some of these businesses, and they don't get bought up by other banks or one of the US tech companies, then there are certainly opportunities in the market as well. I mean, even recently you would have seen Avast joining the FTSE 100, which are a software company that provides mainly antiviruses. But this also could be a really slow process, and we can't expect this to all suddenly change overnight. As you would already know, recovering from a recession is a long and very, very slow process. And despite showing great recovery and quite a spike in recovery in May and June, I definitely think this is going to slow down. As for my stocks, am I going to sell them and reinvest them elsewhere? No. I'm investing in what I understand, in a country in which I live, and I'm going to continue averaging every single week. And I'm going to ride this wave out. No matter how our economy looks, we could be looking at a potential 80% retraction in our economy. Honestly, I'm going to ride the wave out. I'm not going to be spooked. I'm not going to have this tree shaken. I think that it's deliberately quite quiet on the whole Brexit negotiations, and this is more or less by choice. Perhaps they are making some deals and getting some stuff through, but nothing major. But this effectively means that obviously investors are still pricing it in. And once that's released, we might see rallies. I don't expect it to be a quick process, but I definitely feel that the UK has potential to outperform in the future. Oh, and for UK stocks being utter garbage and that you should just throw them away and invest in US, I highly suggest that you look at all 6 of my companies. You've got Boohoo, Games Workshop, London Stock Exchange, Halma, Ashted Group and Softcat. Look at their historical track records. And I know I've said that past performance isn't an indicator of what the future can bring, but seriously, they have significantly outperformed in the past, and I suspect they will continue to do so as they are still generating amazing returns on equity, earnings growth, and subsequently outperforming their competitors. But then you're also expecting the US to continue outperforming as well. So if I'm expecting my UK stocks to continue outperforming and you're expecting the US economy to outperform every other developed nation, then we're both biased. And truly, none of us are right. And subsequently, we both have our faults because of this bias. Regardless, due to my holdings, and since holding Boohoo from July 9th, I am up 28%, or £1,382 in a portfolio that was £10,600 last week, and the week before that, 9,600. This portfolio is like tearing the markets to shreds. Even if the UK stocks are extremely cyclical and therefore quite worrying, you could definitely ride the wave, sell out, and then buy more timing the market, but it's not impossible, it's just not as wise. As with Boohoo, this was never a trade. This is a huge long-term play for me. I'm not selling out at £4, £5, £6, or even £10. I'm going to be holding this one for years, unless some governance issues crop up, which means that they are poorly managed and that the family aspect part of it really is a detriment to the company, then I'm going to stay invested. I might not be buying more at the moment, but I have that huge position size and I'm exposed to it with 56% of my portfolio. And you'll also notice that in the portfolio, I'm only exposed to 2 large cap companies, which are companies with a higher market capitalization than £10 billion. And they're only London Stock Exchange and Ashtead Group. And that you'll also notice that 70% of my portfolio is in stocks under £5 billion, such as Games Workshop, Boohoo, Softcat. These stocks are the ones that I think will do better. And you will realise, right, I only compared the FTSE 100 to the S&P 500. I didn't mention the FTSE 250 or the AIM 100, which they may not have outperformed the S&P 500, but they're smaller size and therefore higher volatility and potentially higher returns. And honestly, have you seen how well UK small cap competes against other markets? I think they had an annual return of something like 34%. Where's your S&P returns on that? And these indexes subsequently far outpace the FTSE 100, and that's why my exposure to it is weak. Yes, I do have Halma and I have London Stock Exchange. Those are more of my defensive plays. They're my hedge in the portfolio that protects me if the Brexit outcome is possibly negative. With London Stock Exchange, I will be looking for opportunities, and hopefully before Brexit people get a little bit scared and start selling out so I can average down. They have a lot of potential for the future and a lot of growth, such as selling their Italian arm and purchasing Refinitiv, which are an investment media company that are insanely crucial in a lot of infrastructure in the stock market. And this is an excellent growth play for the company in the future, and possibly, since the stock price is fairly high, it's around £87 per share, that they could consider doing a stock split. And then that subsequently increases the value, or more people can buy into it, and therefore it's easier accessible and could generate great returns. But obviously this falls in line with the market and how well it does, as after all it is the London Stock Exchange Group. As for Halma, I do suspect they are one of my stocks most impacted by the pandemic crisis, but I do see them as my defensive stock. Year on year, they're going to be growing their dividend by at least 5%, and they've proved that. They've managed to grow their earnings very well by nearly double digits. This is a stock that I think that has performed the worst, simply because I bought that one of the latest in the portfolio and I bought it at a very high valuation. However, this means I can subsequently average down as much as possible and slowly build this position up, as this will protect me from possibly negative outcomes of Brexit and keeps a very low volatility as part of the portfolio. And that's also why 20% of my portfolio is invested in Games Workshop. Not only do they have huge growth potential, but can completely weather the pandemic situation. They've already returned the money that the government offered them for the furlough scheme. Like, they're willing to pay this back because they're insanely profitable. Oh, and if you'd have owned this stock in the last 5 years, with dividends reinvested, you would have had 2,041%. I mean, that's pretty darn good for also a dividend-paying UK stock. This likely won't continue. In no way is this growth sustainable in any way, but I definitely expect it to continue outperforming the market. I really don't think it will even underperform the US market, in which my portfolio really isn't far behind. Currently, I'm 10% behind the S&P 500. I'm beating the FTSE 100 and I'm beating the FTSE 250. I'm only 10% behind, and honestly, anything can happen in the stock market, and these last few weeks I have been tearing the market to shreds. So it might not be long before I'm in fact beating the US market too, although a lot of that is riding on Boohoo. Despite this week Games Workshop dropping by 5%, I'm not buying more simply because it's 20% of the portfolio. That's fine. I just want to really build up the other positions before continuing to build this one up. However, in the future, I will definitely be buying more. It's just the cash position is quite important at the moment. And I'm already 8% up or something like that. And once more, I'm going to be continuing to buy UK stocks. US stocks are an option for the future. Once I think the Brexit situation is well and truly behind us and the pound perhaps regains some strength, I'm going to use that moment of opportunity to open up my self-invested pension plan and invest in US stocks, giving me a balance of US and UK. I know I'm foolish to ignore the rest of the world, but oh well, honestly, it's my stocks in the end of the day. And what I'll do with that is I'll be betting on the pound to decrease over the long term, which historically it's done, and also getting a chance to invest in some of the top tech companies in the US. And if you're interested in my Greg stock analysis, then click the card at the top right of the video. Thank you for watching. This is the Ozbourne Foreman Show. See you Tuesday at 4 PM. Have a great day.